A credit crunch doesn't always start with a crisis. It often starts with banks quietly saying no. Approvals get stricter. Limits get cut. Loan prices rise. And suddenly the economy slows. Not because demand disappears, but because credit does. Credit is the hidden engine of growth. When it tightens, everything downstream feels it. Small businesses delay hiring. Households pull back. Construction slows. And stress spreads faster than most people expect. A credit crunch is not just less lending. It's a chain reaction. It begins when lenders reassess risk because rates are high, defaults are rising, funding costs increase, or regulators push caution. Whatever the trigger, the response is similar. Banks protect their balance sheets. And the easiest way to do that is to lend less. The first stage is tighter standards. Higher credit scores required, more documentation, lower loan-to-value ratios. Less tolerance for edge borrowers. This hits the marginal borrower first, those who could get credit last year but can't now. That's why credit crunches feel invisible at the beginning. Strong borrowers don't notice, but the edges do. And the edges matter, because that's where growth comes from. New businesses, new projects, new hiring. The next stage is pricing. Even when loans are approved, the cost rises. Higher interest rates, higher fees, shorter terms, more collateral required. That changes behavior. Projects that made sense at low rates stop working. Businesses pause expansion. Consumers delay major purchases. The slowdown appears later in earnings, hiring, and GDP. Now zoom in on where lending freezes hit hardest. Small and medium businesses rely on bank lending far more than large corporations. Big companies can issue bonds or access private capital. Small companies usually can't. So when banks tighten, SMEs lose oxygen first. And when SMEs slow down, job growth slows down. This is why credit crunches often show up as soft labor weakness first. Hiring freezes, reduced hours, delayed expansion, then layoffs. A second pressure point is commercial real estate. Commercial real estate matters because it sits at the intersection of banks and refinancing cycles. A large share of commercial loans reset on predictable timelines. And when rates are higher, refinancing doesn't just become more expensive, sometimes it becomes impossible. That creates extend and pretend behavior. Lenders extend terms, restructure payments, or delay recognition of losses just to avoid forced sales. But delays don't remove the risk. They push it forward. And when multiple loans roll at once, the system gets tested quickly. This is why credit crunches often show up first in property markets, office, retail, and smaller regional assets where liquidity is thin. Once distress appears there, banks become even more conservative everywhere else. Loans are often refinanced in cycles. When rates are higher and lenders tighten, refinancing becomes harder. That can force owners to sell, restructure, or default. Even if the building is fine, the financing math can break. And when refinancing breaks, stress spreads. This is why credit crunches can feel sudden. They build quietly during refinancing windows, then show up when large blocks of loans can't roll. A third pressure point is households. Credit tightening shows up in mortgages, auto loans, and credit limits. If households can't borrow, big-ticket spending slows. If spending slows, the economy loses momentum. And if job growth slows at the same time, stress rises quickly. But here's the most important part. A credit crunch doesn't just reflect stress. It creates stress. As credit becomes scarce, defaults rise. And rising defaults cause banks to tighten even more. This is the loop. Tight credit slows the economy. A slower economy increases risk. Higher risk tightens credit further. And once that loop begins, it can accelerate even without a major headline. That's why credit is one of the most powerful transmission mechanisms in the economy. When credit is flowing, problems get financed and delayed. When credit freezes, problems surface quickly. So what should you watch? First, lending standards. When standards tighten broadly, banks are pulling back before defaults spike. Second, credit spreads. When spreads widen, markets are repricing risk, and borrowing becomes more expensive. Third, loan growth. If loan growth slows sharply, expansion slows with it. Fourth, delinquencies. If they rise consistently across households or businesses, the crunch intensifies. Banks respond by tightening further. Fifth, small business sentiment. Small businesses feel credit tightening first. When confidence drops there, hiring and investment usually follow. Here's the key takeaway. Credit crunches are rarely announced. They spread quietly through approvals, pricing, and standards. By the time layoffs appear, the credit freeze often started months earlier. So if you want to understand why economies slow, Don't just watch GDP, watch credit. Because when lending freezes, growth follows.